Artificial intelligence and robotics are no longer futuristic buzzwords. They are transforming industries worldwide, from healthcare and manufacturing to cloud computing and automation. For investors, this revolution presents unique opportunities, and exchange-traded funds, or ETFs, offer a practical way to gain exposure to these high-growth sectors. By investing in AI and robotics ETFs, individuals can tap into diversified portfolios of companies at the forefront of technological disruption, while managing some of the risks of single-stock investing. Among the most notable AI robotics ETFs are Global X Robotics and Artificial Intelligence ETF, BOTZ, Robo Global Robotics and Automation Index ETF, ROBO, and the Invesco AI and Next Gen Software ETF, IGPT. Each of these funds provides a different approach to capturing the growth of AI and robotics, ranging from industrial automation to software-driven innovation. BOTZ focuses on robotics, AI, industrial automation, and healthcare technology, with key holdings such as NVIDIA, ABB, Finac, and Keyence. It carries an expense ratio of 0.68% and currently holds 53 companies. Its performance has been mixed, a modest plus 6.56% one-year return and a strong plus 17.88% three-year return. This ETF offers broad exposure to hardware and software innovators, appealing to investors seeking a balanced play on robotics and AI hardware ecosystems. Robo takes a more diversified approach, spanning robotics, automation, and industrial technology across 88 holdings. It emphasizes long-term innovation with companies like Intuitive Surgical, Zebra Technologies, and iRobot. With a relatively higher expense ratio of 0.95%, it has nevertheless produced compelling results, with a plus 15.56% one-year return, plus 10.96% over 3 years. Robo's strength lies in its broad coverage of automation leaders and its balanced weighting system across different subsectors. IGPT, on the other hand, leans more toward next-generation software and AI integration. With 99 holdings, it captures growth in cloud computing, big data, and machine learning through giants like Alphabet, NVIDIA, Meta Platforms, and Adobe. Its expense ratio of 0.58% makes it the most cost-effective of the three. While relatively new, its performance is promising, plus 14.57% one-year return, making it a strong candidate for investors looking for a software-heavy AI focus. When compared with broader indices, these ETFs show both strengths and limitations.
The S&P 500 SPY returned plus 15.86% over 1 year and plus 19.43% over 3 years, while the NASDAQ 100 QQQ soared with a plus 20.43% one-year return and a 24.80% three-year return. The Technology Select Sector ETF, XLK, with a plus 19.93% one-year return, further demonstrates the strength of large-cap tech. While AI robotics ETFs such as ROBO and IGPT held their ground against SPY and XLK in the short term, QQQ's heavy concentration in megacap technology explains its dominant long-term outperformance.
This performance comparison highlights several key insights. First, AI robotics ETFs vary significantly, with BOTZ showing more modest gains, while ROBO and IGPT achieved stronger recent returns. Second, while broader market ETFs like SPY provide stability, thematic ETFs can be competitive in the right cycle, especially during periods of AI-driven enthusiasm. Third, alignment with the technology sector is evident, but thematic ETFs introduce unique risks due to their narrower focus. Finally, investors must balance growth potential against volatility. AI robotics ETFs are well positioned for transformative growth, but are more volatile compared to diversified indices. Beyond performance, investors must consider risks such as market volatility, concentration risk, regulatory challenges, and the possibility of technological obsolescence. AI is advancing rapidly, but this pace can render some companies obsolete faster than traditional industries. Similarly, geopolitical tensions and trade restrictions on semiconductors could impact AI hardware leaders. In conclusion, AI and robotics ETFs represent one of the most transformative investment themes of the next decade. BOTZ provides a balanced hardware-software exposure. ROBO emphasizes robotics and industrial automation with global breadth. And IGPT captures next-generation software leaders. While broader ETFs like SPY or QQQ may deliver stronger stability and long-term growth, thematic ETFs offer investors targeted access to industries driving the fourth industrial revolution. For long-term investors, the key is diversification, balancing core holdings in broad indices with thematic exposure to AI and robotics to maximize both resilience and growth potential.